It was September 13, 2008. A Saturday. Lower Manhattan was nearly empty, but inside the imposing limestone fortress of the Federal Reserve Bank of New York at 33 Liberty Street, the titans of American finance were gathering for what would become the most consequential weekend in modern financial history. Timothy Geithner, president of the New York Fed, had summoned them all. Jamie Dimon from J.P. Morgan. Lloyd Blankfein from Goldman Sachs. John Tyne from Merrill Lynch. John Mack from Morgan Stanley. They filed into conference rooms, their faces grim, knowing that one of their own, Lehman Brothers, the fourth largest investment bank in America, was dying. Lehman CEO, Richard Fuld, wasn't invited. The man they called the gorilla for his intimidating presence and iron grip on power had run out of options. His firm, which traced its lineage back to three immigrant brothers selling dry goods in Alabama 158 years earlier, held $680 billion in assets supported by only $22.5 billion in capital. It was leveraged 30-1. A mere 3% decline in asset values would wipe out everything. And the assets were declining fast. 6 months earlier, in March 2008, Bear Stearns had collapsed. The government had orchestrated a rescue, lending J.P. Morgan $30 billion to consummate a shotgun marriage. But now, as Lehman teetered, Treasury Secretary Henry Paulson, a former Goldman Sachs CEO himself, had delivered an ultimatum: there would be no government bailout. Wall Street would have to save its own. The weekend became a blur of conference calls, term sheets, and desperate negotiations. Bank of America showed interest, then pivoted to acquire Merrill Lynch instead. Barclays wanted to buy Lehman's good assets but needed the British government to guarantee the toxic ones. British regulators refused. By Sunday night, September 14th, as the autumn sun set over the Hudson River, it was clear no deal was coming. At 1:45 a.m. on Monday, September 15th, 2008, Lehman Brothers Holdings Incorporated filed for Chapter 11 bankruptcy protection. It listed $639 billion in assets and $619 billion in debts, the largest bankruptcy filing in United States history, surpassing WorldCom's 2002 collapse by a factor of 3. When markets opened that Monday morning, the Dow Jones Industrial Average plummeted 504 points, a 4.4% drop, the worst single-day percentage decline since September 11, 2001. Credit markets froze. Money market funds, long considered as safe as cash, suddenly faced runs as investors demanded redemptions. The commercial paper market, the short-term borrowing mechanism that kept corporate America's lights on, seized up entirely. Within 48 hours, the U.S. government reversed course and rescued AIG with an $85 billion bailout. Within 2 weeks, the remaining independent investment banks had either failed, been acquired, or converted to bank holding companies. Within a month, Congress had passed a $700 billion emergency bailout package. The global financial system had come within hours of complete collapse. And it all began with three brothers, a dry goods store, and cotton bales accepted as payment in the Alabama heat. This is the rise and fall stories of Lehman Brothers, the 158-year journey from cotton merchants to the largest bankruptcy in American history. To understand how Lehman Brothers rose to such heights and fell so spectacularly, we must first understand the world into which it was born, a world as different from our own as the cotton gin from the computer chip. When 23-year-old Chaim Lehman stepped off the ship in New York Harbor in September 1844, he entered a country in the midst of profound transformation. America was 68 years old, a young republic finding its footing in the global order. The United States economy in the 1840s was overwhelmingly agricultural. Nearly 70% of Americans lived on farms or in rural areas. The Industrial Revolution, already well underway in Britain, was just beginning to take hold in the northeastern states. Small factories producing textiles, shoes, and basic manufactured goods were sprouting along rivers that could power water wheels. There was no transcontinental railroad, the first wouldn't be completed until 1869. No telephone, no telegraph beyond experimental models. Information traveled at the speed of a horse or a sailing ship. A letter from New York to New Orleans might take 3 weeks. The financial system was primitive by modern standards. There was no Federal Reserve, no SEC, no FDIC. The Second Bank of the United States had been killed by Andrew Jackson in 1836, leaving the nation without a central bank. Hundreds of state-chartered banks issued their own paper currency, much of it of dubious value. Credit was scarce and local. If you wanted to start a business, you borrowed from family, friends, or a wealthy patron, if you were lucky. But in the South, a different economy reigned supreme. Cotton was king, and it ruled with absolute authority. By 1850, cotton accounted for more than half of all American exports. The crop's value exceeded that of all other U.S. exports combined. The invention of the cotton gin in 1793 had made it profitable to process short-staple cotton, which grew readily in the interior South. The result was an explosion in cultivation. Alabama, admitted to the Union in 1819, was at the heart of this cotton boom. Its Black Belt, named for the dark, fertile soil, produced some of the finest cotton in the world. By the 1850s, cotton was Alabama's highest-grossing cash crop, and the state was among the top cotton-producing regions in America. This wealth, it must be stated clearly, was built on an abomination, chattel slavery. By the 1860 census, enslaved people constituted nearly 45% of Alabama's total population. Cotton cultivation was brutal, back-breaking labor performed from sunrise to sunset by men, women, and children who were treated as property, with no rights and no hope of freedom under the law. The fortunes made in cotton, including those that would fund Lehman Brothers' rise, were extracted from human bondage. Lehman was part of a massive wave of German immigration to America. Political upheaval and economic hardship in the German states, which wouldn't unify into a single nation until 1871, were pushing hundreds of thousands to seek new lives across the Atlantic. Between 1820 and 1860, more than 1.5 million Germans would arrive in America. Many were Jewish, fleeing not just economic privation but also legal restrictions that limited where they could live, what occupations they could pursue, and whether they could own property. In Bavaria, where the Lehman family came from, Jews faced quotas on marriages and required special permission to engage in trade. Came from Rimpar, a small Franconian town near Würzburg. His father, Abraham Lehman, was a cattle dealer, one of the few trades open to Jews in rural Bavaria. The family was large, 10 children crowded into modest circumstances. When the sixth child, set sail for America at age 23, he was making a bet that hard work in the New World would offer opportunities impossible in the Old. He Americanized his name to Henry Lehman and set his sights on the South, where he'd heard that fortunes could be made. Henry Lehman arrived in Mobile, Alabama, in the fall of 1844. The bustling port city, situated at the mouth of Mobile Bay where the Alabama and Tombigbee rivers emptied into the Gulf of Mexico, was the gateway to Alabama's interior. On the crowded docks, Henry observed the economic engine that powered the region, cotton bales being loaded onto ships bound for textile mills in New England, and manufactured goods arriving to be distributed throughout Alabama and Mississippi. He spent his first year as an itinerant peddler, loading a wagon with merchandise, pots, pans, cloth, needles, buttons, whatever he could acquire on credit from fellow German Jewish merchants in Mobile and New Orleans, and traveling along the Alabama River selling to farmers and plantation owners. It was hard, lonely work, but it taught him the fundamentals of commerce and, crucially, the rhythms of the cotton economy. By 1845, Henry had saved enough to open a permanent store. He chose Montgomery, Alabama's new capital, a river town of about 6,000 residents, including 2,000 enslaved people, located at the confluence of the Coosa and Tallapoosa rivers. Montgomery was booming, positioned at the intersection of river routes and overland trails, with rich cotton-growing land in all directions. Henry rented a small wooden structure on Commerce Street for his store, Henry Lehman. The location served as both business and residence. Henry lived in back rooms, rising before dawn to open the shop. He stocked a comprehensive array of general merchandise, dry goods, seeds, farming implements, glassware, crockery, tobacco. He offered credit to customers, kept careful accounts, and cultivated relationships with suppliers who extended him credit in turn. In 1847, Henry's younger brother, Mendel, who took the name Emmanuel, arrived from Bavaria. At 20 years old, Emmanuel brought energy and business acumen. Together, the brothers moved to larger quarters at 17, Court Square, the literal and figurative center of Montgomery, and renamed the business Henry Lehman & Bro. They earned enough within a year to purchase the building outright, a remarkable achievement for two immigrants barely in their 20s. The brothers settled into complementary roles. Henry traveled frequently to New Orleans to maintain relationships with suppliers and arrange credit, to the surrounding countryside to cultivate relationships with planters and merchants. Emmanuel, more comfortable with numbers and record-keeping, managed the store and maintained the books. In 1850, the youngest Lehman brother, Meyer, who became Meyer, arrived. At 20 years old, Meyer had witnessed the failed revolutions of 1848 to 1849 in the German states, which had convinced him that meaningful reform was impossible in Europe. He boarded the ship Admiral in Hamburg and arrived in New York on July 17, 1850. Within days, he was in Montgomery, and the firm became Lehman Brothers. The Lehman's general store was profitable, but it was what happened next that would determine their future and eventually make them one of the most powerful financial institutions in America. Cotton planters and farmers regularly offered to pay for merchandise not in cash, which was scarce in the rural South, but in cotton. The Lehmans began accepting bales of cotton as payment. At first, they simply resold the cotton to brokers in Mobile or New Orleans. But they quickly realized that by holding cotton and waiting for favorable prices, or by buying cotton directly from farmers at harvest, when prices were typically lowest, and selling it later, they could make substantial profits. This practice led them to establish a separate commodities trading business alongside their general store. They became factors, intermediaries who advanced credit to planters against future cotton crops, stored and transported the cotton, found buyers, and took a commission on both the lending and the sale. It was a business built on relationships, market knowledge, and access to credit. By the mid-1850s, the cotton trading business had eclipsed the general store. The Lehmans were financing dozens of farmers and plantations, storing thousands of bales, and arranging sales throughout the South and in New York. They were learning, in other words, how to be bankers, how to assess credit risk, how to read markets, how to profit from the spread between buying and selling prices, how to use leverage to multiply returns. The economic conditions were favorable. The 1850s saw cotton prices remain strong, averaging around 11 cents per pound, as demand from British and American textile mills continued to grow. The South was prospering, at least for white landowners, and the Lehmans prospered with it. But then came tragedy. In October 1855, Henry Lehman traveled to New Orleans on business. He was 33 years old, married, and the father of young children. In the Crescent City, he contracted yellow fever, a mosquito-borne viral disease that caused horrific symptoms: high fever, jaundice, bleeding from the eyes and mouth, organ failure. Despite the best medical care available, Henry died on November 17, 1855. Emmanuel and Meyer grieved deeply but had no choice but to continue. The business depended on their constant attention. They continued the practices Henry had established, with Emmanuel making annual buying trips to New York to replenish merchandise and maintain credit relationships, while Meyer stayed in Montgomery managing operations. By 1858, the center of gravity in the cotton trade was shifting from southern ports to New York City, where factors and commission houses were increasingly based, and where most ships bringing cotton to northern and European mills departed from. Emmanuel Lehman opened a branch office at 119 Liberty Street in Manhattan and began spending much of his time there, while Meyer continued to run the Montgomery operations. Then came the cataclysm. In April 1861, Confederate forces fired on Fort Sumter in Charleston Harbor, and the Civil War began. Within weeks, President Lincoln declared a naval blockade of southern ports. The Confederacy's strategy, King Cotton diplomacy, assumed that Britain and France would intervene to secure cotton supplies for their textile industries. They didn't. The blockade was devastatingly effective. Cotton exports from the South, which had totaled 3.8 million bales in 1860, dropped to virtually nothing. Prices in the South collapsed, prices in Europe skyrocketed. The cotton economy that had sustained Lehman Brothers simply ceased to function. In 1862, Meyer Lehman partnered with John Wesley Durr, a Montgomery cotton merchant, to form Lehman, Durr and Company. The partnership was both strategic and personal. Durr's connections helped navigate the chaos of wartime Alabama. Meyer, though living in Confederate territory, tried to maintain neutrality. He raised money for Alabama prisoners of war and in 1864 was appointed by Governor Thomas Watts as a commissioner to visit Confederate soldiers in federal prisons. The war years were lean. The firm survived on what businesses they could conduct, some internal Southern trade, some blockade running, some speculation. But Emanuel, operating from New York in Union Territory, positioned the firm for what would come next. When the war ended in April 1865, the South lay in ruins. The wealth that had existed before the war, much of it in the form of now worthless Confederate currency and bonds, and enslaved people who were now free, had largely evaporated. But there was still cotton. Fields that had been abandoned during the war, and fields worked by newly freed black farmers and sharecroppers, produced a cotton crop. Someone would need to finance it, store it, transport it, and sell it. Emanuel and Meyer Lehman moved their headquarters from Montgomery to New York permanently after the war. But they maintained their Alabama connections and were among the first Northern firms to provide capital for Southern Reconstruction. In 1867, Alabama designated Lehman Brothers as the state's fiscal agent to help sell state bonds. It was the firm's first venture into municipal finance, a business in which they would eventually excel. In 1870, Lehman Brothers helped found the New York Cotton Exchange, a commodities futures market where buyers and sellers could make deals for future delivery. Emanuel Lehman sat on the first board of governors and remained a director until 1884. The exchange brought standardization, transparency, and liquidity to cotton trading. It also placed Lehman Brothers at the center of an important network. The firm's expertise in cotton naturally led to involvement in other commodities. Lehman helped establish the coffee exchange and participated in the petroleum exchange as the oil industry began its explosive growth. But the most significant evolution came in the 1880s, the transformation from commodities brokerage to merchant banking. In 1887, Lehman Brothers became a member of the New York Stock Exchange. This marked their official entry into securities trading and underwriting. They began financing railroad construction, the defining infrastructure project of the late 19th century. They backed textile mills, steel plants, and other industrial enterprises transforming the post-war American economy. The transition mirrored changes in the Lehman family itself. Emanuel and Meyer, now in their 50s and 60s, began bringing the next generation into the partnership. Meyer Henry Lehman, Henry's eldest son, became a junior partner in 1880. Sigmund Meyer Lehman, Meyer's eldest son, joined in 1878 and made partner in 1882. Philip Lehman, one of Emanuel's sons, began working for the firm in 1882. Remarkably, the two founding brothers trusted each other so completely that they did not maintain separate bank accounts. The partnership was held tightly within the family. The first partnership granted to someone outside direct Lehman lineage would not occur until 1924, 75 years after the firm's founding. Meyer Lehman died in 1897 at age 67. Memorial tributes noted his modesty and integrity. He did not build his fortune on the ruin of other men. With prudent care and self-denying life, he slowly added to his well-earned wealth. Emanuel Lehman, the last surviving brother, died 10 years later in 1907 at age 80. Similar eulogies praised him as the same man in prosperity that he was when still at the foot of the ladder. By the turn of the century, Lehman Brothers had fully transformed from a dry goods store accepting cotton as payment into a merchant bank financing America's industrial rise. The second generation of Lehmans, men born in America, educated in American schools, fluent in the language and customs of Wall Street, would build on the foundation the brothers from Rimpar had laid. As the 20th century dawned, America was emerging as an industrial and financial powerhouse. The GDP had quadrupled since the end of the Civil War. Steel production had increased 20-fold. Railroads connected every corner of the nation. New York had supplanted London as the world's financial capital. And Lehman Brothers, under the leadership of the second and third generations, positioned itself at the forefront of financing American business. At the turn of the century, Philip Lehman, Emanuel's son, who had joined the firm in 1882, forged a partnership that would define Lehman's strategy for decades, a relationship with Henry Goldman of Goldman Sachs. Goldman and Lehman identified a massive opportunity: the rise of modern retail. Department stores were replacing small general stores. Chain stores were beginning to spread. Mail-order catalogs were reaching rural America. These businesses required substantial capital to build inventory, open new locations, and finance growth, but they were too new, too retail-oriented, and too unseemly for the old-line banking houses that preferred railroads and heavy industry. Between 1906 and 1926, Goldman Sachs and Lehman Brothers co-underwrote initial public offerings and bond issues for some of the most iconic names in American retail. Sears, Roebuck and Company, in 1906, the mail-order giant that brought consumer goods to rural America. F.W. Woolworth Company, in 1912, the five-and-dime store that revolutionized affordable retail. May Department Stores, in 1910, one of the nation's largest department store chains. Gimbel Brothers, in 1922, the New York department store immortalized in Miracle on 34th Street. R. H. Macy and Company, in 1922, another department store institution. These deals were controversial. Traditional Wall Street looked down on retail as ungentlemanly, the province of shopkeepers rather than captains of industry. But Goldman and Philip Lehman saw what others missed: retail was where the action was. The American consumer economy was being born, and the firms that financed it would reap enormous rewards. The partnership broke apart in 1926 over a deal gone bad and personality conflicts, but by then the pattern was established. Lehman Brothers had a reputation as financiers of emerging industries, willing to take risks that more conservative banks avoided. In 1925, Philip Lehman retired and his son Robert "Bobby" Lehman took over as senior partner. Robert would lead the firm for the next 44 years, the longest tenure of any Lehman leader, through some of the most tumultuous decades in American history. Robert Lehman, born in 1891, was everything the Alabama cotton factors of the 1850s were not. He was educated at Yale, fluent in French and German, a sophisticated art collector who would eventually amass one of the greatest private collections in America, now housed at the Metropolitan Museum of Art. He had an aristocratic bearing and moved comfortably among the financial elite. But he also had his grandfather's instinct for opportunity and his father's willingness to back unconventional businesses. The firm's partnership structure remained intensely familial but was slowly opening. In 1924, John Hancock became the first non-family member made partner, a watershed moment 75 years after the firm's founding. Monroe Gutman and Paul Mazur became partners in 1927, bringing fresh perspectives and new networks. In 1928, Lehman Brothers moved to its iconic headquarters at 1 William Street in Lower Manhattan, a location that would become synonymous with the firm for decades. The stock market boom of the 1920s was dizzying. The Dow Jones Industrial Average tripled between 1925 and September 1929, fueled by easy credit, margin buying, and speculative mania. Lehman Brothers, like every Wall Street firm, made enormous profits underwriting new issues and trading securities. Then came Black Tuesday. On October 29, 1929, the stock market collapsed. The Dow lost 12% of its value in a single day. It was the beginning of a 4-year decline that would see the market lose 89% of its value by July 1932. Banks failed by the thousands. Unemployment reached 25%. Industrial production collapsed. The prosperous America of the 1920s gave way to breadlines and Hoovervilles. It was, by every measure, the worst economic crisis in American history, at least until 2008. Lehman Brothers survived, but barely. Robert Lehman made a crucial strategic decision: while equity markets were frozen, the firm would pivot to venture capital, providing growth capital to promising businesses that couldn't access public markets. Lehman financed young companies in emerging industries, betting that eventually the economy would recover. It was the right call. By the mid-1930s, Roosevelt's New Deal policies were beginning to stabilize the financial system. The Securities Act of 1933 and the Securities Exchange Act of 1934 created the SEC and established new rules for securities issuance and trading. The Banking Act of 1933, Glass-Steagall, separated commercial banking from investment banking, creating a clearer playing field for firms like Lehman that focused on securities underwriting and advisory services. Robert Lehman had a remarkable eye for which industries would define American life. In the 1930s, even as the Depression persisted, he bet heavily on three emerging sectors. 1. Entertainment and media. Lehman Brothers became an early backer of Hollywood, providing financing for Paramount Pictures, 20th Century Fox, Radio Corporation of America RCA, Dumont Laboratories, the first television manufacturer, whose IPO Lehman underwrote in the 1930s. These investments recognized that even during hard times, perhaps especially during hard times, people craved entertainment. Movies provided an escape for a nickel or a dime. Radio brought the world into people's homes for free, supported by advertising. And television, though still experimental in the 1930s, clearly represented the future. 2. Oil and energy. As the automobile transformed American life, Lehman Brothers financed the oil industry's explosive growth. Halliburton, oil services and equipment, Kerr-McGee, oil and gas exploration, Trans-Canada Pipeline, energy infrastructure. 3. Aviation. Commercial aviation was in its infancy, but Lehman saw its potential. The firm provided early financing for airlines and aircraft manufacturers, betting that flight would revolutionize transportation just as railroads had in the 19th century. The Second World War transformed the American economy. Military spending pulled the nation out of depression. Factories that had stood idle in the 1930s ran 3 shifts. Unemployment effectively disappeared. By war's end in 1945, America accounted for half of global industrial production. The post-war period, from 1945 to the early 1970s, would be remembered as an economic golden age. The GI Bill sent millions to college. Suburbanization created demand for housing, appliances, automobiles. Interstate highway construction connected the nation. The baby boom fueled consumer spending. GDP grew at an average of 3 to 4% annually in real terms. The stock market recovered and then soared beyond its 1929 highs. Lehman Brothers prospered with the nation. The firm provided financing and advisory services for the companies defining modern American life. Home appliance manufacturers. Automobile companies, Lehman advised on the Chrysler turnaround. Consumer products companies. The emerging electronics industry. In the 1950s, Robert Lehman identified another transformative trend, the dawn of the electronics age and the early computer era. Lehman Brothers underwrote the IPO of Digital Equipment Corporation DEC, a pioneering computer manufacturer. Provided startup financing for Litton Industries, an electronics conglomerate. Later arranged DEC acquisition by Compaq. In the 1960s, Lehman Brothers was officially designated as an official dealer for U.S. Treasury securities, a mark of the firm's standing and creditworthiness. Throughout this golden age, Lehman Brothers maintained its character as a partnership rather than a publicly traded corporation. Partners had their own capital at risk. Decisions were made by consensus among senior partners. The culture emphasized long-term relationships with clients over short-term transactions. Partners were expected to cultivate deep expertise in particular industries. If an airline needed financing, they worked with Lehman's transportation expert. If a retailer wanted to go public, they dealt with Lehman's retail specialist. This model created lasting relationships. Lehman bankers served on corporate boards, advised on strategy, and were trusted counselors, not just transaction executors. Compensation was distributed based on seniority, rainmaking ability, and contribution to the partnership. The most senior partners could earn extraordinary amounts, but they were also liable for the firm's debts. This alignment of interests created discipline. Partners were unlikely to take reckless risks with their own money on the line. The culture was intensely competitive but also collegial. Partners competed for deals and clients, but they shared in collective success. The firm's success was, literally, their success. But this model had weaknesses. It was difficult to raise capital for expansion. Partners had to contribute more of their own money or bring in new partners who could contribute capital. It was difficult to create incentive structures for younger employees who might wait decades for partnership. And succession planning depended on senior partners voluntarily stepping aside, which didn't always happen smoothly. On August 9, 1969, Robert Lehman died at age 77 while vacationing in Italy. He had led Lehman Brothers for 44 years, through the Great Depression, World War II, and the post-war boom. Under his leadership, the firm had grown from a regional merchant bank into one of the most prestigious investment banks in America. His death left a void. Robert was the last member of the Lehman family to lead the firm. While other Lehmans continued as partners, Philip Henry Isles, a nephew of Robert, had been a partner and director. None commanded Robert's authority or vision. For the first time in 119 years, Lehman Brothers would be led by someone with no blood connection to the three brothers from Rimpar. The question facing the partnership was, could the firm's culture and success survive the transition? The answer, as it turned out, would be complicated. Frederick Ehrman, a longtime partner at Lehman Brothers, assumed leadership in 1969. But almost immediately, the firm faced challenges that Robert Lehman's steady hand had forestalled. The economic environment was deteriorating. The post-war boom was ending. By the early 1970s, America faced a toxic combination of slow growth and rising inflation, stagflation. The causes were multiple. The Vietnam War's massive costs without corresponding tax increases. The collapse of the Bretton Woods system of fixed exchange rates in 1971. The 1973 oil embargo by OPEC, which quadrupled oil prices and sent shock waves through the economy. The S&P 500 fell from 120 in 1972 to 60 in 1974, a 50% collapse. The Dow Jones, which had finally broken above 1,000 in 1972, fell back below 600. Corporate bankruptcies surged. Trading volumes dried up. Companies postponed IPOs and bond offerings. For an investment bank like Lehman, which depended on underwriting fees and trading commissions, it was a brutal environment. But Lehman's problems went deeper than macroeconomics. The firm was suffering from internal dysfunction. The partnership model, which had worked well under strong leadership, was showing cracks. Without a dominant figure like Robert Lehman to impose order and settle disputes, rivalries between partners festered. Strategic direction was unclear. Profits collapsed. By 1972, Lehman Brothers was facing hard times. The firm was reporting losses. Some clients were taking their business elsewhere. There was talk on Wall Street that Lehman might not survive. In 1973, the partnership made a desperate but inspired choice. They recruited Peterson to save the firm. Peterson, then 46 years old, was a remarkable figure. Born in Nebraska to Greek immigrant parents who ran a diner, he had worked his way through Northwestern University, earned an MBA from the University of Chicago, and risen to become CEO of Bell & Howell, a manufacturer of audiovisual equipment. President Richard Nixon had appointed him Secretary of Commerce in 1972, a position he held for a year before returning to the private sector. Peterson was not a Wall Street insider. He had never worked for an investment bank. He knew little about the culture and customs of white shoe firms. He was, in other words, precisely the opposite of everyone who had led Lehman Brothers before. And that was the point. Lehman needed radical surgery. Peterson took over as chairman and CEO in July 1973. His diagnosis was blunt: Lehman Brothers was overstaffed, undercapitalized, and organizationally chaotic. Partners operated as feudal lords, protecting their territories and clients. There was insufficient coordination. The firm was trying to be everything to everyone and excelling at nothing. Peterson's restructuring was painful but effective. Headcount reduction. He cut staff significantly, including some partners. It was controversial. Lehman prided itself on loyalty, but necessary. The firm was burning cash it didn't have. Strategic focus. Peterson pushed Lehman to concentrate on areas where it had competitive advantages: mergers and acquisitions advisory, certain industry sectors, retail, entertainment, technology, and municipal finance. He de-emphasized commodities trading, which had declined in profitability, and proprietary trading, which was capital-intensive. Geographic expansion. Peterson recognized that finance was globalizing. He opened offices in Europe and Asia, positioning Lehman to advise on cross-border transactions. Merger with Kuhnlub in 1977. Peterson's boldest move was merging Lehman Brothers with Kuhnlub and Company, another prestigious but struggling investment bank. Kuhnlub had been founded in 1867 and had financed railroads and played a major role in international finance under legendary banker Jacob Schiff. But by the 1970s, Kuhnlub was fading. The merger, completed in 1977, created Lehman Brothers Kuhnlub Incorporated, the fourth largest investment bank in the United States, behind Salomon Brothers, Goldman Sachs, and First Boston. The results were dramatic. Peterson led the firm from significant operating losses in 1973 to 5 consecutive years of record profits by the end of the decade. Return on equity was among the highest in the industry. Lehman was once again a power on Wall Street. But success created its own tensions. By the early 1980s, Peterson was a Wall Street legend. But inside Lehman Brothers, tensions were building between two cultures: the investment bankers, who focused on advisory work and client relationships, and the traders, who were increasingly driving profits. Louis Glucksman embodied the traders. Born in 1925, Glucksman had joined Lehman Brothers in 1963 after stints at other Wall Street firms. He built Lehman's trading operations into a formidable machine. By the early 1980s, trading accounted for more than half of Lehman's profits, a dramatic shift from the advisor-dominated firm of Robert Lehman's era. Glucksman was blunt, aggressive, and intensely competitive. He had little patience for the genteel manners of the investment banking side. He believed traders, who put the firm's capital at risk and generated immediate profits, deserved more recognition and compensation than bankers who spent months cultivating relationships for advisory fees. Peterson, by contrast, represented the old guard: strategic, relationship-focused, comfortable with CEOs and government officials. He believed investment banking advisory work was the firm's crown jewel, the work that built lasting relationships and reputation. The tension exploded in July 1983. Glucksman, who had been named co-chairman and co-CEO with Peterson in 1983, gave Peterson an ultimatum: retire and hand over sole control, or face a partnership revolt. Glucksman had secured the support of most of the firm's partners, particularly the traders who resented Peterson's dominance. Peterson, recognizing he had lost internal support, agreed to step down. In July 1984, less than a year after being forced out, Peterson co-founded the Blackstone Group with Stephen Schwarzman, another former Lehman banker. Glucksman's tenure as sole chairman was brief and disastrous. Within months of taking control, he made a catastrophic decision to merge Lehman Brothers with Shearson American Express. On April 30, 1984, Shearson American Express acquired Lehman Brothers for approximately $360 million. The firm became Shearson Lehman American Express Inc. For Lehman partners, the deal was financially lucrative. They cashed out their partnership stakes for substantial sums. But for the institution, it was the beginning of a decade in the wilderness. American Express was a financial services conglomerate that owned Shearson, a retail brokerage firm. The strategic rationale was to create a financial supermarket that could offer everything from credit cards to brokerage to investment banking under one roof. It was the fashionable strategy of the 1980s. Citigroup was trying to build a similar model. So was Prudential, which bought Baker Securities. The reality was chaos. Lehman Brothers, which prided itself on serving corporate and institutional clients with sophisticated advisory services, was forced to integrate with Shearson, a retail brokerage serving individual investors. The cultures were incompatible. The compensation structures clashed. Talented bankers and traders left in droves, many following Peterson to Blackstone or joining competing firms like Goldman Sachs and Morgan Stanley. The Lehman Brothers name, which had carried prestige for 134 years, was subsumed into corporate branding exercises. At various points during the American Express ownership, the firm was called Shearson Lehman American Express. Then Shearson Lehman Hutton, after acquiring Hutton. And then Shearson Lehman Brothers. The identity confusion was symptomatic of deeper problems. American Express management didn't understand investment banking. They imposed bureaucratic controls that stifled Lehman's entrepreneurial culture. They forced Lehman to cross-sell American Express products to clients, damaging long-cultivated relationships. They allocated capital based on corporate politics rather than business opportunities. By the early 1990s, American Express had lost patience with the investment banking experiment. The financial supermarket model had failed across Wall Street. Citigroup, Prudential, and others were divesting acquisitions that never achieved promised synergies. American Express decided to spin off Lehman Brothers. On May 31, 1994, Lehman Brothers Holdings was spun off from American Express and became an independent, publicly traded company once again. It was a new beginning, and the start of the firm's final chapter. When Lehman Brothers went public in 1994, raising $3.1 billion in its IPO, it joined a fundamental transformation sweeping through Wall Street. The partnership model, where senior bankers had their own capital at risk, was giving way to the public corporation model. The implications were profound. As a partnership, caution was built into the DNA. Partners who might lose their personal fortunes in a bad bet were naturally conservative. But as a public company, Lehman's executives managed other people's money, shareholders' equity. The asymmetry of incentives was stark. If big bets paid off, executives earned enormous bonuses and stock options. If bets failed, shareholders absorbed the losses. This shift coincided with changes in compensation culture. In 1994, the average Wall Street CEO made about 40 times what the average worker earned. By 2007, that ratio exceeded 300 to 1. Bonuses, once modest supplements to salary, became the primary driver of compensation, often exceeding base salary by factors of 10 or 20. Richard Dick Fuld Jr. emerged as Lehman's leader during this transformation. Born in 1946, Fuld joined Lehman Brothers in 1969 after serving in the Air Force and graduating from the University of Colorado and NYU Business School. He spent 25 years rising through the firm, primarily on the trading side. When Lehman spun off from American Express, Fuld was named CEO. He was 48 years old, and he would lead Lehman Brothers for the next 14 years, right up to its collapse. Fuld's nickname was the Gorilla, and it fit. He was intimidating, demanding, and fiercely competitive. He cultivated loyalty through a combination of charisma and fear. He was known to throw phones and scream at subordinates. But he was also brilliant at navigating Wall Street politics and positioning Lehman for growth. His mission was clear: restore Lehman Brothers to the pinnacle of Wall Street. Never again would Lehman be subordinate to a larger firm. Never again would it face an existential crisis like the early 1970s or the American Express years. To achieve this, Fuld pursued an aggressive strategy: expand into every profitable corner of finance, grow the balance sheet, increase leverage, and maximize returns on equity. The economic backdrop was extraordinary. From 1994 to 2000, America experienced one of the longest and strongest economic expansions in history. Real GDP grew at an average of 4% annually. Unemployment fell from 6.1% in 1994 to 3.9% in 2000, the lowest in 30 years. Inflation remained contained around 2 to 3%, the Goldilocks scenario. The S&P 500 tripled, rising from 459 in January 1994 to 1,469 in March 2000. The Nasdaq Composite Index quintupled, driven by Internet mania. It was the perfect environment for investment banking. Companies were going public at a record pace. IPOs in 1999 raised $65 billion, were then record. Mergers and acquisitions surged as companies used inflated stock as currency to buy competitors. Trading volumes exploded. Corporate bond issuance soared. Lehman Brothers capitalized on every opportunity. Investment banking advisory. Lehman advised on major mergers: ExxonMobil, $81 billion, Travelers Citicorp, $73 billion, SBC Communications Ameritech, $63 billion. Built strong relationships with technology companies preparing for IPOs. Expanded the municipal finance business, advising cities and states on bond offerings. Equity underwriting. Underwrote IPOs for internet companies, Priceline.com, Inktomi, E-Trade. Moved up the league tables, rankings of underwriting volume, consistently finishing in the top 5. Fixed income trading. Aggressively expanded MBS mortgage-backed securities trading. Built a proprietary trading operation that bet the firm's own capital on market movements. Increased presence in derivatives, credit default swaps, and structured products. Growth in scale. Lehman's balance sheet grew from $85 billion in assets in 1994 to $373 billion by 2000. Revenues grew from $2.7 billion in 1994 to $11.4 billion in 2000. Net income grew from $180 million to $2.4 billion over the same period. Return on equity consistently exceeded 20%. In March 2000, the Nasdaq peaked at 5,048. Then the bubble burst. Over the next 2.5 years, the Nasdaq fell 78%, wiping out $5 trillion in market capitalization. Hundreds of internet companies went bankrupt. The IPO market froze. Then came September 11, 2001. Lehman Brothers' headquarters at 3 World Financial Center in Lower Manhattan was adjacent to the World Trade Center. The building was severely damaged in the attacks. One Lehman employee, Matthew Horning, died in the attacks. The firm evacuated and was unable to return for weeks. In the aftermath, the economy slipped into recession. Corporate scandals, Enron, WorldCom, Tyco, rocked confidence. The stock market continued falling. By October 2002, the S&P 500 had lost nearly half its value from its 2000 peak. Most Wall Street firms suffered. Goldman Sachs' net income fell from $3.1 billion in 2000 to $2.1 billion in 2001. Morgan Stanley's fell from $5.3 billion to $3.6 billion. Across Wall Street, there were layoffs, office closings, and cost-cutting. But Lehman Brothers, remarkably, thrived. Fuld made a crucial strategic bet. While equity markets were collapsing, the Federal Reserve was slashing interest rates to stimulate the economy. The Fed funds rate fell from 6.5% in January 2001 to 1% by June 2003, the lowest in 45 years. Low interest rates meant bond prices rose. Bond prices move inversely to yields. They meant mortgage refinancing exploded as homeowners rushed to lock in lower rates. They meant demand surged for any investment offering higher yields than Treasury bonds. Lehman doubled down on fixed income. The firm's traders made enormous bets that bonds would rise, that mortgage volumes would soar, that structured products would be in demand. They were right. Between 2001 and 2003, while many competitors struggled, Lehman Brothers' profits grew. By 2003, Lehman reported record earnings of $2.9 billion on revenues of $14.3 billion. The stock price, which had fallen to $20 in late 2001, recovered to $60 by 2003. Fuld had navigated the crisis masterfully. But the seeds of the 2008 catastrophe were already being planted. Between 2003 and 2007, a series of forces converged to create the greatest housing bubble in American history. Ultra-low interest rates. The Federal Reserve kept the Fed funds rate at 1% from June 2003 to June 2004, the lowest since 1958, to stimulate economic recovery. Even when the Fed began raising rates in 2004, they moved slowly and kept rates low by historical standards. The global savings glut. Central banks and investors in China, Japan, and oil-producing nations accumulated massive foreign exchange reserves from trade surpluses. They invested these reserves in U.S. Treasury bonds and mortgage-backed securities, driving down yields and increasing demand for assets. Financial innovation or alchemy. Wall Street developed increasingly complex mortgage-backed securities. Collateralized mortgage obligations or CMO. Pools of mortgages sliced into tranches with different risk profiles. Collateralized debt obligations or CDO. Securities backed by other mortgage-backed securities. Synthetic CDO. Derivatives that mimic CDOs without owning actual mortgages. CDO squared. CDO made of CDO, complexity layered on complexity. The subprime lending explosion. Traditional mortgages required 20% down payments, verification of income, and good credit scores. But in the 2000s, lenders offered no documentation loans or liar loans. No down payment requirements. Adjustable rate mortgages or ARM with teaser rates that reset higher. Negative amortization loans where the balance increased over time. Subprime mortgage origination exploded from $160 billion in 2001 to $600 billion in 2006, a near quadrupling in 5 years. Perverse incentives everywhere. Mortgage brokers earned fees for originating loans, regardless of quality. Lenders sold mortgages to Wall Street within days, transferring all risk. Wall Street firms earned fees for packaging and selling securities. Credit rating agencies, Moody's, S&P, Fitch, were paid by the firms whose products they rated, creating conflicts of interest. They gave AAA ratings to securities that would later prove worthless. Regulators, believing markets were self-correcting, largely stood aside. The result was predictable: housing prices soared. The Case-Shiller National Home Price Index more than doubled between 2000 and 2006. In some markets, Las Vegas, Phoenix, Miami, Los Angeles, prices tripled. Home ownership rates reached all-time highs as people who couldn't afford homes bought them anyway, confident that prices would keep rising. Dick Fuld and his management team made a strategic decision: Lehman Brothers would be the most aggressive player in the mortgage securitization business. It was where the money was. And so between 2003 and 2007, Lehman acquired mortgage lenders. In 2003, Lehman acquired BNC Mortgage and Aurora Loan Services, subprime mortgage originators. These acquisitions gave Lehman a captive source of mortgages to securitize. By 2006, Aurora was one of the largest subprime lenders in America, originating $20 to $30 billion annually. Ramped up securitization. Lehman packaged mortgages into mortgage-backed securities or MBS and sold them to investors worldwide. The firm became one of the top underwriters of MBS, ranking number 1 or number 2 in market share by 2006 to 2007. Lehman underwrote over $146 billion in mortgage-backed securities in 2006 alone. Built a massive warehouse. Lehman held mortgages and MBS on its own books while packaging securities. This warehouse grew enormous. By early 2008, Lehman held roughly $85 billion in mortgage-related assets. Much of this inventory consisted of Alt-A and subprime mortgages, the riskiest categories. Created and held CDO. Lehman didn't just package and sell mortgage securities, it created CDO and kept many of them. By 2007, Lehman held approximately $40 billion in CDO and other mortgage-related assets that would prove difficult or impossible to sell. Increased leverage dramatically. To maximize returns on equity, Lehman borrowed aggressively. The firm's leverage ratio, assets to equity, increased from 24 to 1 in 2003 to 31 to 1 by 2007. This meant Lehman had only $1 of equity for every $31 of assets, a mere 3.2% cushion. Which mean a 3.2% decline in asset values would wipe out all shareholder equity. The strategy appeared brilliantly successful. Lehman's mortgage business generated enormous profits. In 2005, Lehman Brothers' net income of $3.3 billion, revenues of $19.2 billion. And in 2006, net income increased to $4.0 billion, revenues of $19.3 billion. Then later in 2007, net income of $4.2 billion and revenues of $19.2 billion. Fuld was celebrated. Lehman Brothers was ranked as the most admired securities firm by Fortune magazine in 2007. The stock price reached an all-time high of $86.18 in February 2007, giving the firm a market capitalization of over $60 billion. Fuld's personal compensation reflected the firm's success. Between 2000 and 2007, he earned approximately $484 million in salary, bonuses, and stock compensation. But warning signs were appearing. In mid-2005, housing prices stopped rising in many markets. By 2006, they were falling. In 2007, the declines accelerated. Las Vegas home prices fell 10% in 2007. Phoenix fell 8%. Miami fell 7%. Nationally, the Case-Shiller index declined for the first time since the Great Depression. As prices fell, homeowners with adjustable-rate mortgages faced a double squeeze. Their rates reset higher, increasing payments, while falling home values trapped them. They couldn't refinance or sell without taking losses. Defaults and foreclosures surged. Subprime mortgage delinquencies rose from 6% in 2005 to 14% in 2007. Foreclosure filings increased 75% in 2007 compared to 2006. By the end of 2007, nearly 1.3 million homes were in some stage of foreclosure. The mortgage securitization machine seized up. Investors who had eagerly bought mortgage-backed securities now refused to buy them at any price. Lehman and other Wall Street firms found themselves stuck with billions in mortgages they couldn't package and sell, and with MBS and CDOs they couldn't sell to investors. In April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. It was the first major casualty, but not the last. In June 2007, Bear Stearns announced that two of its hedge funds, which had invested heavily in subprime mortgage securities, had lost nearly all their value. $1.6 billion evaporated. Bear Stearns tried to prop up the funds with its own capital, but by July 2007, the funds collapsed entirely. By August 2007, credit markets globally were in turmoil. BNP Paribas, a major French bank, froze redemptions from 3 investment funds because it couldn't value their mortgage-backed holdings. The European Central Bank and Federal Reserve injected emergency liquidity into the banking system. Dick Fuld and Lehman senior management insisted publicly that the firm was well-positioned. In earnings calls and investor presentations, they maintained that Lehman's mortgage holdings were high quality, properly valued, and hedged against losses. Internally, the picture was different. Lehman's risk managers were raising alarms about the mortgage portfolio. But they were overruled. The firm's traders and executives had enormous personal stakes. Their bonuses depended on reported profits. Marking down the mortgage portfolio would reduce profits and bonuses. So they found reasons to delay write-downs. Lehman employed accounting techniques, later investigated and criticized, to make its balance sheet appear healthier than it was. Repo 105 transactions. Lehman temporarily moved assets off its balance sheet at quarter end using repurchase agreements structured to qualify as sales rather than financing. This made leverage ratios appear lower. This practice, while technically legal under certain interpretations, was later found to be misleading. Valuation optimism. Lehman used internal models to value illiquid mortgage securities, often assigning values higher than market prices suggested. In December 2007, Lehman Brothers reported its first quarterly loss since going public, a $52 million loss in Q for 2007, driven by a $1.3 billion write-down on mortgage-related assets. But management insisted this was conservative and that the worst was over. In fact, the worst had barely begun. On March 14, 2008, Bear Stearns, the fifth largest investment bank in America, teetered on the edge of collapse. A run by creditors and counterparties had drained Bear's liquidity. The Federal Reserve, fearing systemic contagion, arranged emergency financing through J.P. Morgan Chase. It wasn't enough. Over the weekend of March 15 and March 16, the Fed and Treasury orchestrated a forced sale of Bear Stearns to J.P. Morgan for $2 per share, later raised to $10 per share, a tiny fraction of the $170 per share Bear Stearns had traded at a year earlier. The Fed sweetened the deal by agreeing to finance $29 billion of Bear's most toxic assets. The message to Wall Street was mixed. On one hand, the government had intervened to prevent Bear Stearns' collapse from triggering a cascade of failures. On the other hand, Bear's shareholders were nearly wiped out, and management was humiliated. For Lehman Brothers, the parallels were ominous. Like Bear Stearns, Lehman was heavily invested in mortgage-related assets. Like Bear Stearns, Lehman relied on short-term borrowing to finance long-term illiquid investments. Like Bear Stearns, Lehman was vulnerable to a loss of confidence. But Dick Fuld drew a different lesson. He believed Bear Stearns had collapsed because its CEO, Alan Schwartz, had been weak and panicked. Fuld was determined not to repeat that mistake. He would project strength, reassure markets, and ride out the storm. In April 2008, Lehman Brothers raised $4 billion in new capital by selling preferred shares and convertible bonds. Fuld hailed this as proof of investor confidence. The stock price, which had fallen to $30 in March, rebounded to $46. Internally, however, Lehman's mortgage holdings were deteriorating. The firm held approximately $85 billion in mortgage-related assets, including $40 billion in commercial real estate loans and securities, $25 billion in residential mortgage-backed securities, $20 billion in other mortgage-related assets. As housing prices continued falling and defaults rising, these assets were losing value daily. But Lehman resisted marking them down aggressively, hoping for a market recovery. On June 9, 2008, Lehman Brothers announced its Q2 2008 results. The numbers were catastrophic. Net loss $2.8 billion, the largest quarterly loss in the firm's history. Write down $7.8 billion on mortgage and commercial real estate holdings. Leverage ratio still at 28-1 despite the capital raising. The stock plunged 10% on the news, falling below $30. Credit default swap spreads, the cost of insuring against a Lehman default, widened dramatically, signaling that markets were pricing in significant default risk. Fuld announced that Lehman was spinning off $25 to $30 billion of commercial real estate assets into a separate company called Spincos to get them off the balance sheet. But the plan was vague and struck many analysts as desperate. If these assets were as undervalued as Lehman claimed, why spin them off? And who would finance the new entity? Behind the scenes, Lehman's executives were frantically seeking strategic solutions. Fuld reached out to potential acquirers, including Bank of America, Barclays, HSBC, and others. But negotiations went nowhere. Buyers wanted either massive government assistance, as J.P. Morgan had received with Bear Stearns, or prices so low that Lehman would be destroyed. Lehman tried to raise more capital from sovereign wealth funds and private equity firms. But investors were wary. Lehman stock was in free fall, down 70% year-to-date by midsummer. Why invest in a potentially failing firm? Lehman tried to sell pieces of the firm, its investment management division, its commodities trading business. But buyers could smell desperation and offered lowball prices. July and August 2008 were a slow-motion train wreck for Lehman Brothers. In July 2008, Lehman stock fell to $16. Credit default swap spreads widened to over 400 basis points, indicating the market was pricing in a roughly 30 to 35% chance of default within 5 years. Short sellers, sensing blood in the water, aggressively bet against Lehman stock. Counterparty withdrawals. Other financial institutions began reducing their exposure to Lehman. In derivative contracts, counterparties demanded additional collateral. In the repurchase repo market, where Lehman borrowed billions overnight to finance its operations, lenders began pulling back or demanding higher interest rates and better collateral. Client defections. Hedge fund clients began moving their brokerage accounts and cash balances away from Lehman, fearing the firm might fail and their assets could be frozen in bankruptcy. Employee exodus. Key employees, seeing the stock price collapse and bonuses evaporate, began interviewing at competitor firms. Lehman's recruiting efforts, once among the most successful on Wall Street, ground to a halt. Throughout this period, Fuld insisted Lehman would survive. In internal meetings, he was defiant, even confrontational. When executives suggested more aggressive asset sales or dilutive capital raises, Fuld resisted, believing the market would eventually recognize Lehman's value. In August 2008, David Einhorn, a prominent hedge fund manager who had been publicly criticizing Lehman's accounting and asset valuations for months, published a detailed critique. He argued that Lehman was essentially insolvent, that its assets were worth far less than the firm claimed, and that losses would exceed equity. Lehman's executives attacked Einhorn publicly, calling his analysis flawed and self-serving. He had shorted Lehman stock. But privately, many inside Lehman knew Einhorn was largely correct. By early September, Lehman Brothers was running out of time. The final weekend. Friday, September 12, 2008, the clock starts. The week began with more terrible news. On Monday, September 8, the U.S. government had seized control of Fannie Mae and Freddie Mac, the mortgage giants that guaranteed or owned nearly half of all U.S. mortgages. The rescue required $200 billion in government capital. It was the largest financial intervention in American history, until it was eclipsed days later. By Friday, September 12, Lehman stock had fallen to $7.79, down 94% from its 2007 peak. The market capitalization was just $5.4 billion, a fraction of the $60+ billion valuation at the peak. Credit default swap spreads had exploded to over 700 basis points. That afternoon, Treasury Secretary Hank Paulson and New York Fed President Tim Geithner summoned the CEOs of Wall Street's major firms to the Federal Reserve Bank of New York. The message was stark: Lehman Brothers would fail without a buyer or a government rescue. But Paulson, wary of political backlash after the Bear Stearns and Fannie Freddie bailouts, was adamant there would be no government money for Lehman. The industry would have to save itself. Two potential buyers were in play: Bank of America, led by CEO Ken Lewis, and Barclays, the British bank, led by CEO John Varley and investment banking chief Bob Diamond. Both wanted government assistance to absorb Lehman's toxic assets, as J.P. Morgan had received with Bear Stearns. Paulson refused. He believed another government bailout would trigger a political firestorm and create even greater moral hazard. Saturday, September 13, assessing the damage. Throughout Saturday, teams of bankers and accountants from Bank of America and Barclays pored over Lehman's books. What they found was worse than expected. Lehman's mortgage-related assets, carried on the books at approximately $85 billion, were worth far less in reality. Independent valuations suggested losses could exceed $20 to $30 billion. Lehman's equity was only $28 billion. The firm was arguably insolvent already, and deteriorating by the hour. Meanwhile, Paulson convened the Wall Street CEOs in a conference room at the Federation. He presented a proposition: if the private sector formed a consortium to absorb Lehman's bad assets, creating a bad bank similar to what had been done during the 1998 long-term capital management crisis, then perhaps a merger could be consummated. The reaction was skeptical. Why should Goldman Sachs, Morgan Stanley, J.P. Morgan, and others put up billions to save a competitor? Yes, Lehman's failure might cause short-term market disruption. But it would also eliminate a rival and potentially create acquisition opportunities. Still, the CEOs agreed to analyze the idea. Teams worked through the night, trying to estimate how much capital a bad bank would need and how much each firm would contribute. Sunday, September 14, hope dies. By Sunday morning, both potential deals were unraveling. Bank of America, Ken Lewis, Bank of America's CEO, had concluded that Lehman's assets were too toxic and the risks too high. Moreover, Bank of America had a more attractive alternative. Merrill Lynch, the third largest investment bank, was also in trouble. Merrill's CEO, John Tyne, had approached Lewis with an offer to sell. A Merrill acquisition would give Bank of America a premier wealth management and investment banking franchise without the baggage of Lehman's worst assets. On Sunday afternoon, Bank of America and Merrill Lynch agreed to a merger at $29 per share, valuing Merrill at approximately $50 billion. Lewis notified Paulson that Bank of America was out of the Lehman bidding. Barclays, the British bank, remained interested, but there was a critical obstacle. Under UK law, Barclays needed approval from the Financial Services Authority, FSA, and British Treasury to guarantee Lehman's trading obligations during the transition period before closing. Barclays executives flew to London to seek approval. The British government refused. Chancellor of the Exchequer Alastair Darling and FSA Chairman Adair Turner were unwilling to risk British taxpayer money to rescue an American bank that the American government itself wasn't willing to save. By Sunday evening London time, the answer was final: no. Without government backing, Barclays couldn't proceed. The deal was dead. The consortium fails. Meanwhile, the Wall Street Consortium had concluded that the bad bank would need at least $33 billion in capital, far more than the CEOs were willing to contribute. The math didn't work. Several CEOs pointed out that if Lehman's assets were as undervalued as Lehman claimed, the firm should be able to sell them and raise capital on its own. The fact that it couldn't suggested the assets were worth much less than Lehman admitted. By 8 p.m. Sunday night, it was over. Paulson and Geithner informed Dick Fuld that no deal was possible. Lehman Brothers would have to file for bankruptcy. Fuld was stunned. He had believed, right up to the end, that the government would step in, that his position of strength would be rewarded, that 158 years of history couldn't end like this. But it did. Monday, September 15, 2008, bankruptcy. At 1:45 a.m. Monday morning, Lehman Brothers Holdings filed for Chapter 11 bankruptcy protection in the U.S. Bankruptcy Court for the Southern District of New York. The petition listed assets, $639 billion. Debts, $619 billion. It was the largest bankruptcy in American history. When markets opened Monday morning, chaos reigned. The Dow Jones fell 504 points, for 0.4%. The S&P 500 fell for 0.7%. Over $1.2 trillion in market value evaporated in a single day. Credit spreads exploded. The cost of short-term borrowing for financial institutions surged. The commercial paper market, where corporations borrow to finance day-to-day operations, effectively froze. The Reserve Primary Fund, a large money market fund, broke the buck, fell below $1 per share because it held $785 million in Lehman Brothers commercial paper that was now worthless. Panicked investors began withdrawing money from all money market funds, triggering a run on what had been considered the safest investments outside of bank deposits. Lehman's 25,000 employees arrived at offices around the world to find locks changed, computer systems shut down, and security guards escorting them out. Many carried cardboard boxes with personal belongings, captured in iconic photographs that came to symbolize the financial crisis. Lehman was a counterparty in hundreds of thousands of derivative contracts with an estimated notional value of $35 trillion. These contracts, credit default swaps, interest rate swaps, currency forwards, now faced uncertain status. Would they be honored? Cancelled? Renegotiated? The systemic implications became clear almost immediately. If Lehman, a firm embedded in thousands of relationships throughout the global financial system, could fail, then any firm could fail. Trust, the essential ingredient of financial markets, evaporated overnight. Tuesday, September 16, AIG and the panic spreads. The contagion was immediate. On Tuesday, September 16, American International Group, AIG, the world's largest insurance company with $1 trillion in assets, announced it faced a severe liquidity crisis. AIG's problem was a relatively small division that had sold credit default swaps, essentially insurance contracts against bond defaults, on mortgage-backed securities. As those securities collapsed in value, AIG owed tens of billions in collateral to counterparties. It didn't have the cash. If AIG failed, it would dwarf Lehman. AIG had obligations to virtually every major financial institution globally. Its collapse would trigger a cascade of failures that might bring down the entire financial system. The Federal Reserve and Treasury, which had refused to save Lehman just 48 hours earlier, reversed course. On Tuesday night, the Fed announced an $85 billion bailout of AIG in exchange for 79.9% equity ownership. It was the most dramatic government intervention in a private company in American history. The message to markets was confusing and terrifying. The government would save some institutions, Bear Stearns, AIG, but not others, Lehman. No one knew who would be next or what the rules were. The week that changed everything. The rest of September 2008 was a blur of emergency interventions. Wednesday, September 17, Morgan Stanley and Goldman Sachs, the last two independent investment banks, saw their stock prices plunge as investors feared they might be next. Both firms began desperate searches for capital and strategic partners. Thursday, September 18, Treasury Secretary Paulson and Fed Chairman Ben Bernanke met with congressional leaders to warn that the financial system was on the brink of complete collapse. Bernanke, a scholar of the Great Depression, told them, "If we don't do this, we may not have an economy on Monday." Friday, September 19, the Treasury Department announced it would guarantee money market funds, a $3.5 trillion market, to stop the run that had begun when Reserve Primary Fund broke the buck. September 20th to 28th, Paulson proposed a $700 billion troubled asset relief program to purchase toxic assets from banks. Congress initially rejected it on September 29th, triggering a 777-point drop in the Dow, the largest point decline in history. Congress passed a modified version on October 3rd. September 21st, the Federal Reserve approved Goldman Sachs and Morgan Stanley's applications to become bank holding companies, giving them access to emergency Fed lending facilities but also subjecting them to more stringent regulation. The era of the independent investment bank was over. Within 2 weeks of Lehman's bankruptcy, the remaining independent investment bank ceased to exist as such. The government had committed over $1 trillion to bailouts and guarantees. Global credit markets had frozen. The stock market had lost over $8 trillion in value. The global economy was entering the worst recession since the Great Depression. The bankruptcy proceedings. Lehman Brothers' bankruptcy was spectacularly complex. The firm had over 209 registered subsidiaries in 21 countries. It had businesses in derivatives, prime brokerage, securities lending, investment management, and investment banking. Untangling the legal obligations, counterparty claims, and asset recoveries would take years. Barclays acquired Lehman's U.S. investment banking and trading businesses for $1.75 billion, September 2008. Nomura acquired Lehman's European and Asian operations for $2 billion, October 2008. Investment management division sold to various buyers. Headquarters building at 745 7th Avenue sold for $1.3 billion, 2010. Initial estimates suggested creditors might recover only 10 to 20 cents on a dollar. Through aggressive asset liquidation and legal settlements, recoveries ultimately exceeded 40 cents on a dollar. Bankruptcy proceedings officially concluded in 2016, 8 years after filing. Total distributions to creditors exceeded $150 billion. 25,000 employees worldwide lost their jobs immediately. Executives who had accumulated wealth in Lehman stocks or fortunes evaporate. Junior employees lost deferred compensation and unvested stock. Many face stigma in job searches. Lehman Brothers on a resume became a liability. Criminal and civil investigations. In the aftermath, prosecutors and regulators investigated whether Lehman executives had committed crimes. The SEC, FBI, and Justice Department investigated potential securities fraud, false statements, and accounting fraud. Focus centered on Repo 105 transactions and valuation of mortgage assets. After a multi-year investigation, the Justice Department declined to bring criminal charges against any Lehman executives in 2011. Prosecutors concluded that while Lehman's accounting was aggressive and risk management was terrible, they couldn't prove criminal intent beyond a reasonable doubt. The SEC filed civil fraud charges against 3 former Lehman executives, CFO Christopher O'Meara, Controller Martin Kelly, and Vice President Matthew Lee, for misleading investors about Repo 105. These cases were eventually settled without admissions of wrongdoing. Dick Fuld was sued by Lehman's bankruptcy estate, seeking $90 million in allegedly improper compensation. The case settled confidentially. On October 6, 2008, Dick Fuld appeared before the House Committee on Oversight and Government Reform. It was a brutal session. Committee Chairman Henry Waxman noted that Fuld had earned approximately $484 million between 2000 and 2007 while leading the firm to destruction. Fuld defended his leadership, insisting he'd done his best under difficult circumstances. When asked if he'd take responsibility for Lehman's failure, Fuld replied, "I feel horrible about what happened." But he largely blamed external forces, short sellers, adverse market conditions, regulatory failures, and the government's refusal to provide assistance. The testimony did little to rehabilitate his reputation. To the public, Fuld became a symbol of Wall Street excess and hubris. The Examiner's Report, 2010. In March 2010, Anton Valukas, the bankruptcy examiner, released a 2,200-page report on Lehman's collapse. The findings were damning. Lehman used Repo 105 transactions to temporarily remove approximately $50 billion from its balance sheet at quarter end. This made leverage ratios appear better than they actually were. While technically legal under one interpretation of accounting rules, the transactions had no substance, they were purely cosmetic. Valukas concluded there was sufficient evidence to support claims for breach of fiduciary duty against executives including Dick Fuld, CFO Christopher O'Meara, and others. Lehman valued its commercial real estate holdings at levels significantly above market. When challenged by external auditors and internal risk managers, executives resisted write-downs. The overvaluations allowed Lehman to report higher capital and better ratios than reality supported. Senior management ignored repeated warnings from risk officers. The risk management function was subordinate to profit-generating units. Compensation structures incentivized excessive risk-taking. Ernst & Young, Lehman's auditor, allegedly failed to challenge aggressive accounting. EY signed off on financial statements the examiner found were materially misleading. The report made clear that Lehman's collapse wasn't simply bad luck or unavoidable market forces. It was the result of strategic choices, cultural failures, and individual decisions made by people who prioritized short-term profits over long-term stability. When the history of American finance is written centuries from now, Lehman Brothers will occupy a significant chapter. The firm's story is, in many ways, America's story. The immigrant dream, 1844 to 1853 brothers from Bavaria arriving with nothing, building a business through hard work, building relationships, and seizing opportunities in a young, growing country. The cotton economy and slavery, 1850 to 1865. The firm's early success was inextricably linked to the cotton trade, which was inextricably linked to slavery. Lehman Brothers benefited from an economy built on human bondage, a moral stain that can't be ignored. Industrial finance, 1870 to 1920. Lehman helped finance the railroads, factories, and infrastructure that transformed America into an industrial power. The consumer economy, 1920 to 1960. Lehman backed the retailers, entertainers, and consumer goods companies that defined 20th century American life. The technology age, 1960 to 2000. Lehman provided early financing for computers, electronics, and eventually internet companies. The financial engineering era, 1980 to 2008. Lehman embraced securitization, derivatives, and leverage to maximize returns, until these same tools destroyed the firm. In this sense, Lehman Brothers' rise and fall parallels the evolution of American capitalism itself, from mercantile trading, to industrial production, to consumer services, to financial speculation. The firm succeeded by adapting to each era. It failed by adapting too well to an era of excessive leverage and risk. The story of Lehman Brothers is uniquely American, a narrative of immigrant ambition, capitalist dynamism, technological progress, and ultimately, hubris and collapse. From cotton bales accepted as payment in an Alabama dry goods store to mortgage-backed securities leveraged 30-to-1, Lehman Brothers tracked American economic evolution for nearly 160 years. The firm financed the industries that defined American life: railroads, retailers, entertainment, technology. But in its final chapter, Lehman also came to symbolize the dangers of modern finance, excessive leverage, perverse incentives, regulatory failure, and the hubris of leaders who believed they had mastered risk. On September 15, 2008, when Lehman Brothers filed for bankruptcy, it didn't just end one firm's story. It ended an era, the era of the independent investment bank, the era of self-regulation, the era of believing that markets always know best. What remains is memory, lessons, and the question that haunts every boom: are we paying attention to history, or are we doomed to repeat it?